Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis. Today's video is going to be spicy. We're going to be talking about the 0.75% rate hike from the Fed that they just announced today and the impact that it has on the real estate market. In addition to that, we're going to check out an article from CNBC that is stating that pending home sales has actually fallen about 20% year over year. So we're going to digest all of that here today. We're going to go through. It's going to be a great video. I am really excited. Now, before we begin, if you wouldn't mind doing me a quick favor, smash that like button, hit that subscribe button if you want to see more things real estate and finance. Without further ado, let's jump right to it. All right, as expected, the Federal Reserve has raised its benchmark rate by 0.75%, which now sits between 2.25% and 2.5% on the high end. The Fed is caught in an awkward situation of trying to tame rapid inflation, which hit 9.1% last month, and they are trying to avoid a deep economic recession. Now, according to Ben Wick of Business Insider, this rate increase was unanimously supported by the committee, and that this aggressive jump may be the last given consumer prices such as gas are seeing some easing. So now the Fed funds rate here is highlighted in red, and then on the bottom, this is the actual year. So these gray bars here are an indication of a recession. So we had a recession between 01 and 02. We had the great financial crisis between 08 and 2010. And then we had the pandemic, which started in March of 2020. That was a very short recession. One thing that I found interesting here is that the Fed raised rates into these recessions. Once we hit a recession, they dropped the federal funds rate down to almost the floor. After the 01-02 recession, rates went from over 6, about 6.5%, let's call it, down to 1%. And then going into the great financial crisis, they raised rates back up to just over 5%. Once we fell into recession, they dropped the rates to the floor. We were basically at the zero bound here. Now they started to hike rates again in 2016, and they continued to hike through about 2018, and then they started to drop again. When the pandemic hit, rates went back down to zero. And what I find really interesting here is that each time they reduced rates, they made lower highs, meaning in 01, the rate was risen to 6, they dropped to 1, and then going back into the great financial crisis, they were only able to get rates as high as 5, or call it 5.25, before they dropped it back down to 0. And subsequently in 2018, 2019, they got rates just over 2%, call it 2.5, before they dropped them back down to 0. So it begs the question, if we are headed into a recession officially, what is going to happen with the federal funds rate? Will they capitulate and drop the rates back down? Only time will tell. Now, the article goes on to say that in the meantime, this will serve to further cool the housing market. This means that debt will be more expensive, but that acquisition will be easier given reduced demand and competition for real estate assets. So in other words, they're going to say, they are basically saying that interest rates are going to go up, but there is going to be some demand destruction because these assets are going to be more expensive to purchase them. Now, Rachel Siegel of the Washington Post reports on the impact housing played on the Fed decision to raise rates. Another force playing into the Fed's interest rate decision is the slowing housing market. The Fed's previous rate increases and expectation of more have caused a brisk run-up in mortgage rates. Yeah, mortgage rates have basically doubled since the beginning of the year. We've seen a little reprieve as of late, but they're still much higher than they were in, let's say, January. Now, this is, of course, pushing more buyers out of the market. Existing home sales fell in June for the 5th straight month, according to the National Association of Realtors. And although the median sales price of a house rose to $428,000 in June, compared with last year, there are indications that prices are starting to ease in some markets. Real estate, of course, is always local, so you got to really pay attention to the local markets, even though we are speaking at a national level right now. So it just says inflation hits a new peak. Last month, we saw 9.1% inflation. If you take a look at this chart here, the last time we saw anything nearly as high as what we saw this last year was in the 80s. Where we saw a massive peak in inflation here, just over 14%. But what's interesting or what a lot of times they don't mention, is that the CPI today is calculated differently than it was in the 80s. I would imagine if CPI was calculated today the same way it was in the 1980s, we'd probably see inflation pretty close to this peak. Now, the last thing that this article touches on here with regards to this rate increase is how it impacts mortgage rates. Now, according to Jacob Channel, LendingTree's senior economist, he notes that oftentimes lenders have already priced in the upcoming Fed rate hikes into their rates. So in this case, we may not see a dramatic increase in mortgage rates in the short term. Further, Greg McBride, which is the chief financial analyst of Bankrate, comments that more rate hikes now mean fewer later, meaning a timetable for peak interest rates is closer than we think. So according to both of them, they are stating that maybe the peak is already in. Maybe we have priced the higher Fed funds rate into the mortgage market already. Generally speaking, mortgage rates tend to track the 10-year Treasury yield. And when the Fed raises the federal funds rate, generally speaking, the 10-year Treasury yield will follow. Well, in this case, Fed funds rate went up and that 10-year Treasury yield actually went down on that news, meaning mortgage rates actually improved slightly. All right, so now I want to show you this CNBC article that is talking about pending home sales falling by about 20% in June versus a year earlier. So this article is pretty interesting. There's a couple key points that I want to point out, but it just says, as I mentioned, that existing home sales dropped about 20% in June compared to a year ago. That's according to the National Association of Realtors. This, of course, was the slowest pace on record since September of 2011, with the exception of the first 2 months of the pandemic in March of 2020. That was more of an anomaly where we saw everything kind of freeze up. Now, on a monthly basis, pending home sales fell 8.6% in June. So sales activity is slowing down. That is what they're talking about here. Now, a Dow Jones survey of economists had predicted only a 1% drop. Now, the steep decline coincided with a sharp jump in mortgage interest rates. The average 30-year fixed loan crossed over 6% in the middle of June. So January of this year, interest rates for a 30-year fixed mortgage were at about 3%. Those rates nearly doubled. In some cases, they were over 6%. Since the height of those 30-year fixed mortgage rates, they have moderated a little bit. Right now, depending on how you qualify, you're likely going to be in the low to mid 5% range. So they are slightly lower than 6%, certainly higher than they were in the beginning of the year. Now, it says that these high rates and inflation in the general economy are hitting buyer sentiment hard. So absolutely, I mean, it's demand destruction. You know, interest rates go up dramatically, the cost to borrow and the cost to own a home, it becomes out of reach for more and more people. In other words, it's impacting affordability. It's less and less affordable. So what happens? Buyers just start to back out of the market. It pushes more people into the renter pool, which means there's less buyer competition and ultimately leads to more and more housing inventory. Now, here's a short video clip. I'm going to play maybe 20, 30 seconds of this.
Mortgage demand dropped again, even though rates dropped a tiny bit. You take a look at this. Rates came down. The average rate on the 30-year fix for conforming loan balances decreased to 5.74% from 5.82%, and that's for loans with 20% down. Still, applications for a loan to buy a home fell 1% for the week, but were 18% lower than the same week 1 year ago. More supply is coming onto the housing market, but prices and rates and high inflation, it's all weakening consumer demand and confidence. Applications to refinance a home loan fell another 4% for the week, and they were, get this, 83% lower than the same week 1 year ago.
Wow, so that is really interesting. So you see purchase application volume drop by about 18% over year. That means there's less buyers that are out there actively shopping. Refinance demand dropped by 83% year over year. That is a massive shift. Of course, it is widely expected because if interest rates were hovering at or around 3% more than a year ago, and people started to take advantage of those low interest rates, those who refinance, they already locked into really super duper low 30-year fixed rate debt. Why would they take a higher interest rate today unless they absolutely had to? Now, to piggyback on the video there by Diana Olick, the article goes on to say, according to Lawrence Young, the chief economist of the National Association of Realtors, he says that contract signings to buy a home will keep tumbling down as long as mortgage rates keep climbing. There are indications that mortgage rates may be topping or very close to a cyclical high in July. If so, pending contracts should also begin to stabilize. Now, the article goes on to break down the reduction in sales in each region. It says the drop in sales was widespread, with the South and the West seeing the worst of it. In the Northeast, looks like pending home sales were down 17.6% year over year. In the Midwest, they saw a reduction of about 13.4% annually. In the South, pending home sales were down about 19.2% from the previous year. And then in the West, so if you're in California, you know what I'm talking about, pending home sales were down approximately 30.9% year over year. Now, to wrap up this article, I want to share one more quote by George Ratiu. He says that looking ahead, a slowdown in economic activity and pullback in business investments could lead to a moderation in the pace of mortgage rate gains as investors shift allocations towards the safety of bonds. In other words, investors are starting to rotate their money out of, let's say, the stock market and into the bond market. When bonds go higher, yields go lower, which actually helps reduce mortgage rates. And then he goes on to say that combined with the increase in housing supply, we could see improved opportunities for home buyers later in the year. So this quote really kind of cracks me up. I actually was watching the George Gammon channel, or the Rebel Capitalist channel. If you don't know what that is, you should absolutely follow his channel. George puts out tons of really great content. And one thing that he mentioned here is that he talks about improved opportunities for home buyers. And it kind of really cracked me up, because nobody wants to admit that home prices could actually come down, at least not the mainstream media, especially the senior economist at Realtor.com. That's not a slam on him, but he works for a real estate company or real estate brokerage, which has a vested interest in selling property, in having transactions take place, right? So nobody wants to say that home prices will actually go down, but they say things like improved opportunities. So what does improved opportunities actually mean? Well, for the most part, it means if you have more inventory, a buyer will have more room to negotiate. And how do you negotiate? Generally in two ways, on either price or on terms, right? So terms would be like, hey, we want maybe a seller credit to cover closing costs, or we would like a credit to buy down the interest rate, or a credit to maybe cover a certain amount of repairs, or maybe we want you to fix some of these items before we take possession of the property. And then, of course, the other way to negotiate it is price. Like, hey, I'm no longer willing to pay, let's say, $500,000 for this property, but I am willing to pay $450,000. And if you don't have any buyers lined up, what is a seller to do? A seller has to either entertain that offer or say, you know what, we're going to pull it off the market and do something else. So it just puts some control back in the hands of the buyer, which is what I think he means by improved opportunities. All right, well, that is going to wrap it up for today's video. We covered the Fed rate increases. We covered pending home sales. I hope you found the information useful. Please consider liking and subscribing if you haven't done so already. I would encourage you to leave a comment. The comments really help me as well as others learn and grow. Would love to hear from you. What's going on in your market? How do you think the Fed funds rate increase will impact the housing market? Leave your comments below. Thank you so much. We'll see you on the next video.